Hi everyone, and thank you for taking a few minutes to check in. As we reach the midpoint of 2026, it's been a year defined by powerful and often competing market narratives, and that complexity is exactly what we've been focused on. The first half of the year reminded us just how quickly markets can shift. In the spring, geopolitical tensions escalated dramatically, with the US conflict in Iran shaking trade routes in the Middle East. This sent shockwaves through global commodity markets. Oil prices surged to over $120 per barrel, and equity markets responded with heightened volatility, with the S&P 500 pulling back nearly 9% at one point during the spring. What's important, however, is how quickly these narratives evolved. As tensions stabilized and supply concerns eased, oil retraced sharply and now sits below $70 per barrel. At the same time, equity markets have rebounded. The key takeaway from this period is that markets are being driven not by a single story, but by multiple, often conflicting forces: geopolitics, inflation expectations, and economic resilience, all playing out at the same time. Looking ahead, we believe the dominant narrative for the rest of the year will shift from geopolitics back to central banks. Specifically, the leadership of the new Federal Reserve Chair, Kevin Warsh. He is stepping into a very challenging environment. On one hand, inflation expectations remain elevated. On the other, the US economy continues to show resilience. And adding to that complexity, there is clear political pressure to keep interest rates low heading into US midterm elections this fall. This places the Fed in a delicate position, balancing the credibility of monetary policy, the strength of the economy, and the expectations of both markets and policymakers. Historically, midterm election years are the most volatile in the presidential market cycle. Given today's pressure points, we expect that pattern to continue. Despite all of this uncertainty, there is one powerful and consistent force supporting markets, and that's the ongoing AI-driven investment boom. We are currently witnessing one of the largest waves of capital investment in US corporate history, led by companies like Microsoft, Nvidia, Meta, Amazon, Google, and increasingly supported by government initiatives in the United States and abroad. SpaceX brought to market the largest IPO in US stock market history, while Anthropic and OpenAI wait in the wings for their much-anticipated IPOs over the next 12 months. These companies are minting multi-millionaires across the AI industry at a rate not seen since the tech boom of 2000. But don't be fooled, this isn't just a short-term trend. It's a structural shift that is helping to underpin economic growth, corporate earnings, and long-term productivity. So, what does all of this mean for your portfolio? It means we remain disciplined and diversified. We recognize that volatility, especially in a year like this, is not something to fear, but something to manage carefully. We continue to position portfolios to participate in long-term growth opportunities like AI innovation, while also maintaining diversification and investing in old-world economy industries like banks, industrials, utilities, and healthcare. These are industries that are poised to be secondary benefactors of the AI boom. Periods like this reinforce the importance of staying focused on long-term goals, rather than reacting to short-term headlines.